Welcome to Education by Integrity Capital. If you're watching this for the first time, it's clear that it is your first time buying a commercial real estate investment property. So congratulations. It's an exciting time for you and one that deserves a lot of attention and understanding about the process. The objective today is to inform and educate you on the specifics on what it takes to prepare on getting financing to buy an investment property for the first time. The whole concept of acquiring an investment property from the lender's perspective is this whole idea of reduction of risk. I want you to think in terms of that in almost every decision you make from a financing perspective. The lender is always going to look at all of the variables within the acquisition to determine what is the risk and how do we reduce that risk. What you're probably used to is perhaps residential acquisition financing or refinancing. And in that model, yes, they do look at the property, but predominantly they're going to be looking at you first and then the property. In an investment commercial real estate acquisition, the lender is predominantly going to look at the asset first as its primary source of repayment, and then you second as a secondary source of repayment, which is some terminology you'll start to understand. So again, overall, understand that is what it is that they're going to focus on. So we're really going to look at 4 different categories as far as from a lender's view, a lender's perspective, on preparing on how to underwrite and finance a commercial real estate property. The first one is collateral. The second one is character. The third is credit. And the fourth is cash flow. From the lender's view, they're going to look at the collateral. And what do I mean by collateral? Well, the real estate, the physical real estate itself. What is the property type? Is it an apartment? Office, retail, industrial? Is it a special purpose property, meaning that is it a auto mechanics facility? Is it a restaurant? Is it a hotel? Special purpose means that it's used specifically for that purpose and nothing outside of that. Again, this is something that you want to know up front and first and foremost. Those property types are going to really make a big difference in how you approach the property and how you approach the underwriting. For example, if it's an apartment, we're not going to really look at each tenant because it's not as significant. There's a lot of them and they're smaller. When we look at perhaps a single tenant, we're going to predominantly look a lot at the actual tenant themselves and underwrite the capacity for them to be able to actually pay the rent each month. So again, property type is a very, very big deal in what it is that you're looking at. If it's a mobile home park, we're going to want to know, do you own the land under it? Do you own the actual mobile homes itself? And how long have they been there? Are they on month to month, or is it perhaps on a longer term lease? Again, risk versus reduction of risk. The second thing in that category of collateral is going to be location. What is the physical location of it? Is it in a small rural town? Or is it in a large major metropolitan area which has 100, 200, 300,000 plus people that again reduces the risk of the lender because it's more viable to release it if you lose some tenants versus a small town, which again in their mind increases the risk because again it's a smaller town, not as high populous, and it's harder to get a tenant in there if you lose somebody. The other aspect of the collateral is the physical tenants. As I mentioned, is it single tenant? What is the percentage, if it is multi-tenant, that tenant actually takes? Do they take 20, 30, 40% of the actual space? Are they all coming due at the same time? Are they 3-year leases and everything comes up in the next year or two? So they would call that rollover risk. Is every tenant coming due at the same time, which again provides risk to the lender, provides risk to you, makes it a less viable property for them. Things that they're going to want to know is, are those tenants going to renew or not? Very important information to know. And then the industry types. What type of industry are those tenants or tenant in? Is it a mortgage broker? Is it the restaurant industry? Again, Is it a gambling field? We want to know what are the specific industries that those tenants are in. Very important because, again, it's going to be really different if I have a tenant that's in the restaurant industry than somebody that perhaps is a Walgreens on the corner. Again, rated differently, risk is different. Very important that you understand that concept. The other aspect is, what is the history of the property? How long has it been built? How long has it been around? Has it been leased the whole time, or has it been vacant for a long time? That history is really, really important to understand as far as risk and reduction of risk. Visibility. Is the property visible, or is it tucked back in? Perhaps it's a neighborhood property and it does really well in North Scottsdale. Perhaps it's a self-storage that's off the beaten path but does really well because it fits the neighborhood. Again, those things are really important, is what's the actual location. And then the other thing would be, is it fee simple land or is it on a land lease? Most institutions are going to want to see something on an actual fee simple where you own the land under it versus a land lease. And if it is a land lease, we want to know, how long is that land lease? Is it 5 years, 10 years, 15, 20, 30? The longer the lease is, the less risk. If that lease comes due and you own the real estate on top of it, they have every right to kick you off. Again, a risk versus reduction of risk. The second aspect we're going to be talking about is character. So what do I mean by character? Now I'm talking about you. They want to know about your particular character, meaning what's your background, what's your history, how long have you been doing this? Is it your first time? Do you have any management experience in this particular area or not? Again, a very big deal for a lender to say, you might be buying a great property, but you just don't have the experience, which again always comes into play. Perhaps you're going to offset that with somebody that actually has a lot of management experience. So a really big deal for you to understand. The other aspect of that is, what is your financial capacity? Another thing they're going to look at. Do you have a lot of cash flow outside of this? Do you have a lot of actual cash as well? They want to see that perhaps you have a secondary source of repayment. If all of those tenants go out, do you have the capability of spending the money to release it? Perhaps to spend the money to improve the property? Maybe some air conditioning units went out. Or have you blown through all of your reserves? Again, they want to know that you have the financial capacity and capability to sustain the property if something ever happens. And then finally, your personal credit. Do you have some dings on your credit in the past? Some mortgages, late mortgages, short sales, bankruptcy, foreclosures. All of these things come into play as your credibility is either diminished or it is raised up depending upon that final credit score. And if you do, we definitely want to be able to prepare the lender with information so they know how to underwrite if it was perhaps a one-time incident or not. The fourth aspect, because we talked about character and we also talked about credit, is finally cash flow. Cash flow is king. This is the thing the lender is going to look for, is, does the property cash flow? And frankly, so do you. You want to know, can you actually pay back the debt service at the end of the day? The lender is going to look at the gross revenue. They're going to take a vacancy factor, whether it's fully occupied or not, just based upon the market. They're going to look at the operating expenses of the property. Are they standard to market or are they not standard to market? They're going to adjust it accordingly. They're probably going to strip out of that underwriting some reserves. What do I mean by that? Tenant improvements and leasing commissions. They're going to put maybe 10 or 15 cents multiplied by the square footage as an additional fluff factor when they're underwriting to get to that final net cash flow number at the bottom. It's that figure that the lender is going to use to calculate what we call the debt service coverage ratio. That means that if the property nets, after all the expenses, vacancy, and reserves, $125,000, and your debt payment based upon the amount you're borrowing is $100,000, that means they're going to multiply the $125,000, which is the net cash flow, divided by the actual debt on an annualized basis. So if we just use basic math, that would be a 1.25 debt service coverage ratio. Again, let me just reemphasize that again. They're going to take the gross rents minus a vacancy factor. They're going to take whatever the standard operating expenses are, come to a net income. They're going to strip out an additional reserve factor, maybe 10 or 15 cents multiplied by the square footage off of that number to get to a net cash flow figure. And then they're going to divide that by the debt service. So that's really imperative for you to be prepared and to underwrite accordingly so that you know if it's going to meet the stress test or the standard for the lender that is going to be funding your loan. So again, just to recap, remember we're talking about collateral, character, credit, and cash flow. The lender is always going to look at what is the risk on those things. They're always going to try to find ways to reduce that. Personally, that's our job, to help package it appropriately, to help reduce that risk so that the lender is in the appropriate position to have the most fruit and the most abundance to be able to lend money to you. So finally, what is kind of the next step for you based upon this information? You're going to have to provide our institution with the appropriate amount of information in order for us to make a decision for you. That's going to look like the following: a personal financial statement, which shows your assets and your liabilities for your personal financial statement. We have a form that we can provide you. 3 years of personal tax returns, preferably the most recent year, then 2 prior. Signed, and we need the full tax returns. Thirdly, a P&L statement for the last 3 years. What do I mean? Profit and loss statement for the actual property that you're looking at. We need to see that there is a trend and a history, so we need the last 2 to 3 years, give or take. A rent roll. What do I mean by that? The rent roll is going to show you the tenant, the square footage, how much they're going to pay each month, their start and stop date for the lease, and if there's any bumps or any additional information we need to know. Fourthly, color photos. We need to actually see the property. Does it show well? Is it a little rough and tumble? It's really important that we see some color photos of maybe the inside and the outside. Fifth, property details. We want to know square footage, what is the age, the parking, the land size, condition, all the little ins and outs. A lot of times if they have an old appraisal that can provide that information, they might have a marketing flyer as well. 6, verification of the down payment. We need to know, where's the money coming from? Is it a 1031 exchange or is it just cash? 7th, tenant financials. This is only if necessary. If you have a tenant that takes a large chunk of the space, or if it truly is single tenant, we're going to need the financials for that particular tenant. And then finally, again, if there's any credit issues, Lord willing, that we need to know what the specifics of those credit issues are so that, again, we can prepare that and present it in the light that it needs in order for you to get past that hurdle of risk versus trying to reduce that risk. So what are the next steps for you? Again, collect the information that I just described and then contact your representative with Integrity Capital to go to the next step in preparing to get you some financing for that acquisition of an investment property. So thanks for offering us your time today to get more informed about acquiring a property for the first time. We're looking forward to working with you and serving you. Have a great day, and God bless.